G'day and welcome to this week's video. My name's Robert Gowdy from Consortium Private Wealth, and this week we're going to have a look at superannuation and considering whether it always has to be the default. Now, in the financial advisor world, superannuation is large bulks of our discussions. It could be 80% of the conversation when people are retiring. How do we get it in? Small business capital gains exemptions when people are selling businesses. And so it should be. It's an extremely attractive tax rate, particularly when you're retired, and we'll go through the upside in a second. But here we're going to consider whether it should be the default always, and particularly when you look back in the past, the tax-free threshold where you paid no tax. This is going back away, but $5,400 was the figure where you paid no tax. That figure is now $20,000 per year for someone that is working and is under age 65. So let's jump in and just have a look at obviously why super is super attractive, and that is whilst you're in accumulation and you're working, any concessional contributions, which are employer contributions or salary sacrifice or tax deductible contributions, concessional contributions they're called as a whole, are taxed at no more than 15%, and that's compared to your marginal tax rate. Once you get over 37,000 and up to 90, you pay 34.5%, and you can pay over 47%. So that's where 15% is extremely attractive. So that's why these are some of the low-hanging fruit that we speak about. You need to make sure you have taking advantage of this tax rate if you're paying high marginal tax rates. Any asset you've held for longer than 12 months within superannuation comes with a third discount on the 15%. So you only tax at 10% on in superannuation assets on the capital gain. And once you get to over age 60 and you're retired, you will pay no tax on the earnings within the fund, and you'll pay no tax on the pension that's paid out. And that's up to a maximum of $1.6 million each. So a couple can have $3.2 million in superannuation in pension mode. Once retired above 60, can pay zero tax. So extremely attractive. But what are the tax rates in retirement? So once you're over age 65, a couple can earn about $29,000 each, or not far off $60,000 per year. A single, that goes up to 37, and that includes the low income tax offset and also the seniors and pensioner tax offsets. So that's a lot of money that you can earn taxable income without obviously having to pay any tax. So when we think about obviously capital bases, lump sums of money, and the low cash rates, so how much money would you actually need before you actually start to pay tax? And as always, it depends on how the money's invested. So if we're purely talking about term deposits, then the amount of money for a single, and assuming we're getting say 1.3%, which that's probably about at best at the moment, unfortunately, and we are expecting these low rates to be about for a good while to come, could be 10, 20 years, that at 1.3 in a term deposit, to get for a single to get up to $34,000 per year, which is the approximate figure, it's not exact, you would need a capital base of $2.6 million. If we're talking about a more traditional balance fund, where there's a mixture of say 40% conservative assets and 60% growth, and you're earning an income return, not the capital gain, of 2.8%, you'd need $1.2 million in capital before any tax is paid, and for a couple you'd need over $2 million. So you can have a huge amount of money before you start to pay any income tax. So super is clearly not always and doesn't have to be the default. The downside to this is capital gains. We're only been talking about taxable income. So when people have capital gains and that capital gains is triggered, the net capital gains is added to taxable income. But of course, capital gains can be managed, particularly in direct share portfolios where you can sell down losses to offset gains and things like that. And particularly with a buy and hold strategy like we have here in our business. We try to find the best businesses in the world for our clients to own for the rest of their lives. You don't need to realise a capital gain if that business continues to be an incredible business. So they don't need to be realised for the retiree, and then through the estate. The beneficiaries do not need to realise the assets. They can inherit the Google shares or Microsoft shares, and they do not need to sell them, therefore not triggering the capital gain. So capital gains can be managed. There's other considerations. Years ago, superannuation assets in pension came with certain concessions for the income test. In more recent years, those concessions have gone. That's been quite a while. When we're going from superannuation structures, whether it's a self-managed retail industry fund, and then we go invest in a more direct way where we're not using managed funds, we can potentially reduce fees on an annual basis. And one other thing we need to be mindful of is, while as a couple you can earn $58,000 tax-free. So if someone is earning, say, the assets would bring in $60,000 per year as a couple. When someone passes away, there's clearly tax implications when there's a single and not a couple. So for those reasons, we need to be particularly careful and definitely use superannuation, because we know at some point in their retirement they will not be there as a couple. Someone will pass away and all that income will stream to the one person. So just a bit of lateral thinking. Superannuation does not have to be the default each and every time, and it can save fees. It can provide us a simpler way to invest. It doesn't have to be superannuation structures like a self-managed super fund, which are complex. Things can be simpler if you choose. Anyhow, just some general information for you. Thank you for listening. Please subscribe to the channel if you haven't already done so, and those that have, thanks very much, and we'll speak to you soon. Bye.